You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. So we looked at some protective strategies the last couple of weeks, particularly talking about FANG stocks. The example we did last week was on Apple, and the stocks have rebounded. But hopefully the protective strategies allowed you to stay in these type of stocks and look for that rally to the upside. I think that they make a lot of sense on stocks that when you get a little bit nervous about the markets, but you still want to be bullish on your underlying. So we looked at doing a long put spread as opposed to just buying a put outright. All right. So with that said, Apple ran up quite a bit. Your long put spread allowed you to stay in on it. And ideally, it was a perfect scenario because we were more bullish than we were bearish by buying some protection. If you were 100% bearish, you should have just sold Apple. And that's always something to keep in mind. If you do any type of protective puts or protective put spreads, you really want that protection to go away. I mean, you don't want to go out and buy car insurance and say, oh, my policy is expiring, I better go crash my car. You know, that's not the scenario. You don't want to have to use it. So just keep that in mind. And with that said, we're going to move on to our trade this week. And I'm going to jump a little bit off the deep end. Options Playbook Radio is always meant to talk about the 40 different option strategies for bulls, bears, and rookies, all-stars, and everyone in between. That's basically the title of the book. And so one of the strategies that I've never talked about on the long side is just buying a straddle. We haven't looked at buying long straddles, I don't think, in the history of Options Playbook Radio. So, as always with Options Playbook Radio, nothing's meant to be a recommendation. We're just trying to learn. So our paper trade for this week, I think I found an underlying that I wouldn't mind considering a long straddle on. And the biggest thing about long straddles is that you're just paying up. You're paying a lot of time premium, and you need a fairly big move. But the stock that we're going to look at today is Boeing, symbol BA. That's B as in Boeing, A as in Apple, BA. So that stock right now, I should say we are taping Options Playbook Radio on Wednesday, June 12th, and the markets are open. So Boeing's having a rough day today, and they've had quite a few rough days. They had some good news saying that the demand for their planes is still high, but then they keep getting bad news and that the accidents in their planes that have crashed, a couple of them. And so it's just all over the place. And what made up my mind to try to do a long straddle in Boeing as our paper trade this week is that I looked at the implied volatility charts in the Ally Invest platform. And within the platform, we have a volatility chart that compares apples to apples. We look at the 30-day historical volatility for Boeing, and we compare it to a 30-day weighted implied volatility index, much like a VIX on Boeing. And that is actually back to the low end of the range ever since Boeing has announced, or I should say, since the troubles have started. So when the trouble started, Boeing spiked up on this 30-day volatility to about 40% for the year. That's the highest it was for the year. And we're now down to 25%. Now, before all the news, the lowest it ever was 19%. So we're definitely on the low end of the range, but I do not think that all the news has played this course out. So when I'm thinking of a long straddle, I'd rather be in something that has potential to have news as opposed to looking at a long straddle before a known news event, which a lot of people use them for. Example would be earnings. A lot of people like to do long straddles before earnings, but the price of the options is already baked into it. So Boeing down another $5. It's kind of the chart looks extremely volatile, but implied volatility has came in. So with that said, that is the rationale why we're going to buy a long straddle, and we're going to go out further in time. We need some time. Time has to be our friend. And we're going to be buying a at the money call, and we're going to be buying an at the money put. The expiration that I'm going to use here, now I kind of go back and forth on this. Boeing is supposed to announce at the end of July. The last week in July is the projected earnings announcement. They don't have an official date yet. And you could do this type of trade if you go out to August, but August gets a little bit expensive. The August straddle with the stock at 343 right now, and the market's moving, so I'm just going to round off 343.50. We look at buying the 345 call, the 345 put. That is trading. Those options are pretty expensive going out to August, which is over 60 days out. They're trading for a net debit at a midpoint of $33.25. So $3,325 to buy one long straddle. And that's just a little bit too expensive for me. I kind of like the concept of being in earnings because with implied volatilities in the lower end of the range, you would expect implied volatility to increase going into earnings, and that kind of helps you out on the long straddle, owning this much premium. But I'm going to make the official paper trade for this week, the July 19th expiration long straddle. They're trading, the at the money option contracts are trading at about 25% vol right now, implied vol. And we can get it done for almost $1,000 less. So once again, I'm going to keep Boeing right where it's at, 340.50. Down $5.82. The market is open today. It is June 12th. It is a Wednesday. We are looking at buying the July 19th expiration, 37 days away, 345 strike call, and then buying the same expiration, 345 strike put. This is done for a net debit of $22.75 to the account. And if we do this trade, we're just hoping that the volatility in Boeing continues. We're hoping that the marketplace being at the low end of the 52-week range is too low, and that there's going to be some more major news coming out before the July expiration, 37 days away, that will make Boeing move at least the $22 that we're looking at in one direction. And I think that, once again, if you're ever thinking of long straddles, and I'm always looking at Options Playbook Radio as, well, let's try to find a scenario that a strategy could work. This strategy may be better than that strategy. I have no idea where Boeing's going to go, and I don't think anybody even at Boeing has any clue, because the news is driving the stock, not the fundamentals of the company. The news is much more important than the fundamentals at this point in time. So eventually it's going to play its hand, but at this point in time, we're going to do this long straddle, and we can trade. Don't feel guilty. You can trade one option in one direction. In other words, if I get a 15 to 20 point move bull from here, from 340, 350 up 15 points or more, or to the downside, down 15 points or more, I have no problem either closing out the call for a profit or closing out the put and letting the other one ride. That's a very possible scenario in this to do if you feel that right at the time of the trade. Now, my biggest thing is don't sell it too early. If you put this trade on and it goes down 5 points on the put side and then you made a few bucks there, so I'm going to close it out, I want to make sure that if I close one of these out, it's going to pay for the opposite side. That's just going to be my one rule here. I feel that people that do long straddles close them out too early, or especially if they're legging in or legging out of the trade. Okay, so this is a simple trade, but it is one of the hardest trades to do time and time again and be profitable on it. And I think one of the biggest reasons why people have problems with it is they're doing it around major news as opposed to doing it like in Boeing in anticipation of major news, right? Just kind of hoping that the news cycle isn't over in Boeing. And that's why I think this type of trade is a solid trade or a solid paper trade. Once again, not meant to be a recommendation for Options Playbook Radio. And this will be the first time we've looked at a long straddle. So I am anticipating a question, and this is a fairly expensive trade at, if we bought this right now, it's trading at $22.75, so $2,275 for every 1x1 long straddle. And if we look at that and we think about the total cost of this trade, then some people might say, why not do a strangle? Why not buy an out of the money put and buy an out of the money call? And when it comes to buying long strangles, they are a lot cheaper overall, but you just don't get the bang for your buck. You know, the concept of a long strangle, buying out of the money just to be cheaper, you just don't get the delta. And the way that I look at a trade like this, the delta of my call, if it goes up, or the delta of my put, if it goes down, needs to get to one in a hurry, because for every dollar it goes up on the call and I'm making money, I'm losing money on the put. So I like the delta scenario in a long straddle much more than a long strangle. So we need this scenario. We need our call delta or our put delta to get to one as soon as it can, right? Because if our call delta is at 1, it's working really hard to offset the losses on the puts and vice versa. So that's why I prefer a long straddle, which means we're buying the same strike, put and call of the same expiration, as opposed to buying an out of the money put and an out of the money call with the same expiration. All right, so with that said, and anticipating the question of why not a long strangle as opposed to a straddle, let's do a quick summary. Right now, the market is open. It is June 12th. It is a Wednesday. Boeing today is already down $5.82. Last trade was $343.52. We are looking to buy one July 19th, 345 call, and at the same time, buy one July 19th, 345 put. The midpoint, if we can fill at a midpoint in our paper trade, is $22.75. For every 1x1 straddle, that means you're paying $2,275 plus commission to get into the trade. That is going to be your max risk, and your max profit is unlimited to the upside or substantial to the downside, only because the stock could go to zero on the downside, and there's a stopping point. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S guy at invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.